Episode 578, Trading Justice Podcast. Justice Brothers coming at you on Mother's Day. Before we say anything else, happy Mother's Day to those listening, to those who are celebrating. Matt, before we get into all of that, we have a wonderful mother. She listens to the podcast.
She does.
She watches us. So I'm not allowed to say anything except Happy Mother's Day, Mother. Mom, and you're not allowed to say anything until you say
Happy Mother's Day, Mother. We love you very much. You're the best mother in the history of mothers, and we are very excited that we were blessed with you as our mother.
Yeah, like seriously, Mom, Happy Mother's Day.
Now she's happy.
She is happy now. We know our mother very well. She's gonna be very happy, but that's
good to go. Yeah.
Listen, we're going to break down earnings. We're going to break down an improving condition in the chart, but does it have support of other elements to it in the market? We're going to talk about gold. We're going to talk about oil. Really excited to get the earnings report card from Matt. My brother is an expert at earnings. He really is. That is not promotion. That is a fact. But what is promotion is, Matt, you have a little bit of an event coming up this week in which you are presenting, you're speaking. Tell us a little bit about that.
Yeah, I'm presenting on AI in the marketplace at a virtual event called the New Tools of Money. It's going to be an amazing event. It's got a tremendous amount of just absolute experts on different topics, from gold to Bitcoin mining to tax strategies to, obviously, I am going to be speaking on AI. There's going to be an investor panel where you could ask questions, get the help you're looking for, and it's a free event. It's going to be absolutely amazing. It's on May 16th, this Thursday, from 9 a.m. to 1 p.m. And even if you can't make it, sign up so you can get on the email list to get the recording for the event. And looking forward to it. Very excited. Excited for our tackle trading community to be a part of this event. So definitely check it out. The link to sign up for the event this Thursday will be in the description, and we're gonna have a lot of fun, and something that I love talking about because I do see it as the number one growth opportunity over the next 10 years. I think it's something that we are just getting started in, and that is AI and the AI space. And so if you are looking for more information on AI, if you're looking for more information on, alternative asset classes, commodities, currencies, crypto, this is going to be an amazing event. So definitely check it out. Sign up. You won't regret it. It's going to be time well spent.
No, and Matt did a trio of shows on AI for our coaches show that we have archived. Matt, you are developing yourself into a little bit of an AI little guru here.
From a market perspective, yeah, I enjoy the topic. I enjoy doing research on it. Last year when this whole thing started off with NVIDIA's earnings report a year and a half ago, about now, we saw something from a revenue perspective. We saw something from a growth perspective that we just hadn't seen in a very long time, and that set forth for an amazing discussion on AI. And obviously, a lot of times when people come to these opportunities that emerge in the market, if they don't catch that first wave, they kind of feel like, oh, I missed it. I just want to remind people that first wave in Bitcoin went from like $10 a coin to $100. And now we're talking about Bitcoin at $60,000. And so realize there's tremendous growth in front of us, and there's going to be ebbs and flows. And so we're not just going to focus on the what is AI, but ultimately there's two questions you got to answer. And I think those two questions are the same questions you got to answer when it comes to, trading or investing in any asset class, whether it's crypto or currency or commodity based or, mutual funds, ETFs, or individual components in the stock market. You got to answer two questions. And the only way to answer those two questions are from an education perspective. And that's, are you paying the right price? And is this the right time? It's all about time and price. And so not only are you going to learn about AI and learn about all these alternative asset classes, well, at Tackle Trading, our focus is on teaching people the evaluation of time. Is this the right time? And is this the right price? And so we're going to have a lot of fun. Hopefully we get a lot of our community there.
Yeah, absolutely. No, and seriously, Matt approaches AI, and it's funny, like I'll push back because I'm very much a contrarian and sometimes a negative Nelly. And I'll say something, behind the scenes as Matt, and Matt will immediately just be like, blah, 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 right? With fact, and this and that. I'm like, all right, I'll take back my
I have
thought.
a numbers-based argument that will eviscerate any
Yeah.
opinion out there.
So and Matt approaches AI, like he said, from a much different perspective than a lot of people that he just, one of these true leader in the field. And so, looking forward to the event. Once again, as Matt said, it's in the description. Sign up for that event. It is worth your time. AI is probably going to produce more than a handful of trades, understanding it, understanding what to look for, probably make a couple bucks over the
And honestly,
decade.
the last thing I'll say on the AI front is I do see the AI growth areas of the market as the number one growth opportunities in the market, probably since the tech boom started in the mid 1990s. I would even put it well in front of the markets that were the number one growth-based markets from 2010 until 2020. That 10-year stretch of growth in the market was unlike anything we've ever seen in the history of the modern markets. And yet I still believe AI has the ability to produce further gains than what we saw in that decade. And so if you think about it from that decade perspective, we're in 2011 right now. And so I think it's extremely important to be familiar with these topics. I think it's extremely important to not only be familiar, but learn as much as you can about these topics, because they're going to be dominating the marketplace over the next 10 years.
Yeah, so often as traders, we have this very short-term vision. I mean, and we get caught up, and sometimes we forget the forest from the trees. This week, well, you'll be outlining those forests for us. Let's get back to the trees, though, for a moment, Matt. The S&P 500, decent short-term technical situation. It's been an improving condition. We've been pretty darn good for a while on this podcast, on our calls, on our general look. We're very hesitant and kind of mocking bears, being like, listen, you ain't won anything yet. There's a lot of development here. It's played out that way, and now we're lifting up. What are you seeing? What are you seeing? What's your general take of the technicals right now in the broad markets?
Well, I think in general, you're looking at improving conditions across the board. We talked about last week with the weekly chart confirming off that bullish pullback, with the anticipation that the daily chart was going to do that this week. And that's exactly what we got. We got the daily chart confirming to basically realign the two most important timeframes for the market. And that would be the daily chart tracking the short-term trends, and that would be the weekly chart tracking the intermediate trends. And so when the daily chart and the weekly chart do get aligned, it typically does produce a little bit of a cleaner environment in general for the market. And I would say that the market is much cleaner today than it was a week and a half ago, 2 weeks ago, and definitely 3 weeks ago when we got that pocket of volatility once we clipped that 50-period moving average in the marketplace. But ever since then, Mark, 5K played out the way that it was anticipated to play out. You got decent patterns underneath the moving averages to give you a little bit of a time correction to go with your price correction. But the problem is you got to. That's the good part, right? Technically, improving conditions, very good development of patterns underneath. There's really nothing wrong with the technical backdrop from the low point. But the equation technically is not just evaluating support, it's evaluating where something can go as well. And so when you're looking at support, you're like, yeah, I got confidence in support right now. I have confidence in the short-term analysis, but where can it lead to is the ultimate question.
Yeah, kind of, because there's like two levels of analysis. How far can something go down? and then how far can it stretch, right?
Yeah, it's like, okay, so how far can something go down right now? Probably not a lot right
You,
now.
a lot, a big, you got a lot of,
Well,
something would have to jolt this market to break
you
through
would
all
have
of
to have
that.
the CPI miss on the top side to, and we'll get into that here in a second. But from a technical perspective, you're kind of looking at the improving conditions, saying, yeah, I like the improving conditions. We upgraded the S&P 500 to a slightly bullish ranking over the weekend in the Tackle Trading newsletter. Definitely, if you are not reading that newsletter as your go-to to get ready for the market coming up and to understand the market that we just went through last week, I would highly recommend you start your trading week with that Tackle Trading newsletter. But when you're looking at where something can go, you're not getting into an open air. And that's the problem here, Mark, with the technical backdrop. And again, I don't want to come across as negative Nancy here, but at the end of the day, that two-pronged evaluation of confidence is building in support, but how much confidence do we have above 5,300 here when you're currently at 5,250? And so you only got a short distance until you get into that overriding resistance level. And I think that's the most important thing to make sure that our communities are understanding is an improving backdrop is good. It's positive. We have we're certainly slightly more confident on the overall trajectory of the market, but you really have an opinion at 5,300 as well. And you want to see that development at 5,300. And so 5,300 is the next great test for the marketplace. It's the all-time high price. You're most likely going to see a scenario where you see some degree of pattern development at 5,300. And ultimately, if we are going to see that leg in the market, the improving conditions above the 90 MA on the short term, the 50 SMA on the short term, getting above the 50 SMA this week, and then playing defense all week. And again, an improving condition. But we're going to want to see ultimately the market get above that 5,300. And when you're looking at the combination, I can see some things develop that look fairly good right now. And one of the patterns that I see kind of emerging here with the combination of RSI being slightly overextended right now, with the market kind of coming into that 5,300 zone, is you could see an environment where the daily chart kind of fades into 5,300, consolidates a little bit. And what happens with RSI is really important here, because RSI the market doesn't need to come down for RSI to come down. The market just has to slow down volatility and get into some more.
Yeah, you don't bring up RSI very often. So when I saw this in your pre-notes, I'm like, you're seeing something.
Yeah, I'm seeing a pattern that I typically do see on a slight bull edge here, where you get RSI slightly overextended. The S&P is kind of overextended a little bit, but what you see is short-term consolidation in the price to give you a little bit more of a high base fill here. And as you go through a high base against the price action, RSI actually contracts in a high base. And so even though the price stays neutral at the top end, RSI does come down. And then when you do break out, you have RSI underneath 70 breaking out on the price. RSI would confirm that. And then when you look at the weekly chart's already underneath 70. And so you could see an environment by the end of this week, Mark, where RSI is underneath 70 on the daily chart. It's underneath 70 on the weekly chart. And you're talking about that multiple time frame breakout of 5,300. Because remember, in this entire conversation, the dual-pronged approach of the weekly chart and the daily chart confirms an improving condition. What it does not do is confirm a multiple time frame breakout. And that's the importance of the 5,300 zone. And so if you're talking about a breakout in the marketplace, it's probably going to be because you get a positive reaction to a slight miss on CPI. Obviously, the market would embrace a little bit of an interest rate conversation there. You work up into 5,300 and then you flatline. basically creating a multiple time frame situation going into next week with the potential of the breakout of 5,300. And so I do see that as a scenario. And I also think that when you're looking at the volume right now in the market, we got confirmation last week on the weekly. We got it this week on the daily. But Mark, this week, even though you had a very good week in the marketplace, this week was really 2 days. You had a good day on Thursday and you had a good day on Monday. Outside of that, it was doji, doji, doji. So you had 3 dojis, 2 upward moves in price this week. It was all done on lighter than expected volume, showing you there's not a lot of participation out there right now. And specifically, where is the participation coming right now in the marketplace? Yes, the entire market had a good week last week. When the market goes up, everything in the market went up. You look at the weekly heat map, for example, real good week in the market, no doubt about that. But when you kind of come into the data and you look at what areas of the market were the best last week, well, utilities, number one sector last week was utilities. The number one sector in the last month is utilities. And then just specifically last week, utilities, finance, industrials, basic materials, consumer defensive. Those are the 5 best sectors in the market last week. Once again, where's technology? Where's consumer discretionary? Where's communication? It's hard for me to see an environment where you get a breakout of 5,300, but it's the defensive areas of the market leading the charge. And so the market is improving, but it's improving on the backdrop of the defensive areas and the cyclicals getting shored up. And it's been doing that on a little bit of lesser than average volume. Now, maybe that's just because last week we didn't have a lot of economic reports and we didn't have a lot of the earnings reports that have been dominating for the previous 3 weeks. But what we do want to see is a 5,300 breakout against RSI coming down a little bit. And then on that 5,300 breakout, we want to see an increase in volume. So if we get that, and again, I don't think that's too much to ask, but again,
no, that's not one of these down,
it's an if A then B scenario. It's not.
There's not a lot of variables there.
No,
right?
It's a miss on it. It's a slight miss on CPI. Market works up into 5,300, consolidates for the rest of the week, and then we get a multiple time frame breakout of 5,300. That's the scenario as a bull you want to see play out. As a bear, I just don't feel like, even if we get a little bit of volatility on CPI report this week, I don't think you can outside of bear hedges, I don't think you're going into that thinking too aggressive on the bear side, especially with a lot of the short-term moving averages working as a support level underneath right now.
It just has not. And this is one of the things that, you and I have been very, very, very public about. This did not feel like this volatility we had, nor does it now feel like the start of the next great bear market, right?
No.
It just does not. We were very much on the bull are going to win here. Just where do they win, right? Where do they win? Do they win at 5,000? Do they win at 4,850? But they were going to win this little thing. How much they continue winning, probably will have to.
For us, the question was, do they win at 5K and that's 3 weeks ago. They've been winning.
Yeah.
That wasn't a question for last week or the week before. But 3 weeks ago, the ultimate question was, where do the bulls step in? Do they step in at 5K, which they ultimately ended up doing, or do they step in at 4,800? We really didn't have a bear thesis there. We had a neutral, let the volatility kind of play out thesis. It worked out the way we thought it would. But again, I guess my point is, with low volume, with defensive basically leading the charge right now in that low volume, working into 5,300, I don't think you take it as a rip the face off bull move here. No. I think you take it as a gift on the bull side of the equation. But the real conversation as of right now is not on anything between 5,200 and 5,300. As long as you stay between 5,200 and 5,300, we're talking bull side of the equation. Underneath 5,200, it gets a little bit choppy. You're back down into some degree of neutrality. But I don't think you're embracing the bear here outside of maybe some hedges until we get far better patterns on the bear side of the equation. And that could play out here, Mark. It absolutely could play out here, but you got to see that first. You got to see the development there first, because we've been just seeing too much good development on the bull side over the last 2 weeks.
Yeah, it's just that simple. It's just that simple. Now, if you're going to break 5,300, or the Bears are going to recapture their glory from the vicious 6-day sell-off that occurred a month ago, it's going to probably lie in the inflationary data that's coming out this week. Last week, Matt, nothing happened. It was, Karkashi spoke, I don't know, 18 times. I don't know what he said. He said some words. Some Fed officials were speaking last week. Nobody remembers anything they said today.
Nobody cares about anything they have to say. That's the thing the Fed has to understand. They are the boy who cried wolf. We don't believe you. We don't trust your data. And we certainly don't trust what you say about the data.
I trust that you might be looking for jobs like Robert Kaplan landing a job at Goldman Sachs.
A former Fed official going to work at Goldman Sachs is not news on breaking news.
But needless to say, as far as monetary policy, but this week you're going to have some actual data, Matt. You're going to have some actual data after a very light week.
Well, can I just say one thing on the Fed very quickly?
Dude, you can say 40 feet. I'm in the mood to go off on something. So,
I'm not in the mood to go off on, because I
can tell.
More important than they truly are. But it's when everybody in the world knows you want to cut rates for whatever reason, for the election reason, for
we all know what
the financing, the debt refinancing issue, for whatever reason, we all know that you have a desire to cut rates.
Yep.
Which means I believe you are biased on your data. I think you're parsing the data in a way that supports your argument, instead of allowing your argument to be based on data. And I do a lot of data-based arguments. That's how I do all of my theses in the marketplace. They're data-based arguments. I just feel like the Fed they got the bias goggles on, and they're begging for data, which means they're parsing the data that supports their argument, and they're discounting the data that doesn't. And by the way, I get it. They're saying the right things. That does not mean they're going to do the right things here. I'm sorry. I've seen the Fed talk and talk and talk and talk. I do not trust what they say, especially coming from Kashkari. That guy's I don't trust anything that guy says. He is a modern monetary theorist. He has embraced MMT from the very, very beginning. And it's only after it was proven historically damaging to his personal reputation how terribly wrong he was on the opinion of transitory. And yes, Powell gets a lot of the blame for transitory. Kashkari was the devil in the ear on that conversation. And he's going to own that too. And so he's trying to whitewash that one away on this. I don't think, and I wouldn't trust it, because at the end of the day, if they cut interest rates in this environment, that's the only thing you need to know, because the environment does not call for interest rate cuts. I think, Mark, you and I can agree on that. The environment does not call for interest rate cuts. You have an improving economic condition with inflation still being sticky. You got to be vigilant on the fight against inflation. With inflation showing its ugly little double dip head here, you got to chop that sucker off. You cannot, that's a double tap. Remember, I give this analogy on inflation a lot. It's like the bad guy in a horror movie. You can't just shoot him one time. You got to double tap that one. Inflation it's the most lagging of economic indicators. You think you've gotten a good track on it. You take your foot off the gas pedal and it comes right roaring back. You got to make sure you stomp that into the ground on the inflationary front. It takes
there's a long history supporting that, like the entire history of the world.
The entire history of currency, it supports what I said. So yes.
Like, well, listen, we're going to get that next inflationary data point. We're going to get a couple of them this coming week. This week, we have PPI ahead of CPI. Get those producers. It's hard to see that not come in supportive. knowing that oil doesn't have as big a component in some of the CPI metrics, but it does in the PPI. Will you speak to that? Just give us a little preview of inflation this week.
Well, it is inflationary week, and our community at Tackle Trading is extremely familiar with the inflationary week as we talk about it. As it outside of about 8 months of data last year, where it became a secondary topic, it's really been either 1A or 1B in terms of the most important economic report to the marketplace, and that would be CPI. There's a lot of ways to track inflation, but the core ways of tracking inflation are you get the preferred Fed gauge out of the PCE report. Then you get the two reports that Wall Street probably anchors against a little bit more than even the PCE report. The Fed's tried to make the PCE report the end all be all of reports, but we still track PPI and CPI as much as anything. When you're looking at CPI report, that's headline inflation. That's what we are all dealing with right in front of our very eyes. It's the final print against what we are paying out there. And CPI is expected to come in at 0.3 and 0.4, which would be a slight reprieve from the bump up from last month. But there is an elevated expectation going into this print, and so I would put the edge on a miss. That's where I personally would put the edge, because you do have a little bit of elevated expectation, especially when within CPI coming in at expectation of at a 0.4. Year over year expected to contract from last month's 3.5 down to 3.4. The CPI report, once again, is the headline inflation. It is the number one economic report of importance to the market right now. And typically speaking, you got to treat CPI like you treat a Fed date, like you treat the labor market, in the sense that for about the first 30 minutes of CPI day, it's going to be an algorithm response. It's not going to be a human being response. We're all going to be sitting watching the price action, waiting for the slowing momentum out of that. But you get a big algorithm response just based on the headline, and then you get a secondary response after we actually get to parse the data within the CPI report. That's on Wednesday. On Tuesday, you get the PPI report. Now, personally, I wish we would get the PPI report before the CPI report all the time, because CPI report is a much more.
When I told you last week that we were getting the PPI first, your head about exploded. You're like,
we usually don't.
You're like, oh, wait.
Okay, they're going to do something that makes sense. They're going to put pipeline in front of core.
It makes sense to do it this way, doesn't it?
It makes sense to have pipeline inflation to give you an understanding of the inflationary coming down the road impacting consumers today. Usually it's CPI then PPI though, but this week we do get PPI then CPI. PPI report is the producer's price index. CPI report, I'm willing to bet we're going to be talking a lot about housing on CPI day, a lot about the shelter index on CPI day. It's the biggest impact of inflation, and it's a massive problem right now is the shelter index. When you're talking about PPI report, what's going to be interesting on the pipeline is I expect to miss on pipeline.
It's hard to not see a miss on pipeline.
If a miss on CPI, I would say is a slight bump, a slight probability on miss on CPI, but I would put it slightly higher on the PPI side of the equation, because I do think you can look at specifically oil and some of the commodities coming down a little bit. Precious metals have been really, really good, but precious metals aren't exactly an inflationary impact. They do have it, silver, platinum, palladium, those types of them, but gold, not necessarily. And so when you're looking at the PPI report with what's happened with crude in the last month, should have a little bit of reprieve on the energy side of the equation within PPI.
I mean, if they can lie about it when crude oil's up 10%, then my goodness, crude oil down 10% in a month.
So you're going to get some actual here.
Wow.
But I don't know if they're outright lying. I do think they are. I think in general, my opinion of every economic report, and they're all a snapshot of an environment. They're not 1000% truth of the economic standing in America. That's not what economic reports are. In fact, I would say most of the time economic reports basically show a glorified version of what real America is dealing with, quite frankly.
Yeah, I wish we had an after hours podcast show, right? Because you can be nice and I'll be polite. And then in the after hour show, you would see me all drunk being like, those slovenly cheating, they're gonna.
Listen, every country manipulates their economic data. That is the reality and the truth of the situation. Because you're competing with other countries out there. There's lots of competition out there, but so there is always a fudging of the economic reports. But I will suggest they're a little bit more ambitious on the fudging of the economic reports these days. I will agree to that, no doubt about that. But it's not just inflationary week. It's going to be interesting. I wonder why Chairman Powell's giving a speech on Tuesday and not Wednesday.
I'm glad. Well, and it's I believe it's in Belgium. Maybe he's like celebrating the Eurovision, contest this weekend, and he wanted to get to some of the after parties there.
But talk about European inflation, don't you have
it is scheduled. It's I like that it's right there in a 24-hour period. We get PPI, PAL, and CPI, right? Just let's do this.
Honestly, a 24-hour period this week, you get all the economic reports.
Let's do this. Let's do this right now.
Out of the way. And so by Wednesday morning, we're going to have a really good understanding of what the market's kind of.
And retail sales, right?
You get them all. The Empire State Manufacturing Index, you get CPI, you get retail sales, you get PPI, you get Chairman Powell, all from 8:30 Tuesday to 8:30 Wednesday. It's all right there. So we're going to have a really good understanding economically on the monetary side. And if you get a miss, you're most likely talking perhaps the dual-pronged approach of, because I could see an environment where misses on inflation this week for whatever reason, but misses on inflation this week. If you have misses on inflation this week, you can have an environment where the market starts embracing the Fed cut conversation. And if they embrace the Fed cut conversation, it's going to be really interesting to see the conversation on the Russell 2000 at 2100 versus the S&P 500 at 5300. Because the one scenario where the Russell 2000 can outperform the S&P, because in the S&P, you got the big ducks, you got the generals out there, you got Mag 7. In the Russell 2000, you got none of that. You got no big time leadership in the Russell 2000. It's an entire index. And the one thing that could really help that index is, because they're very economically sensitive companies in the Russell 2000, is if you do get a miss on the inflationary side of the equation, the market embraces a little bit of a interest rate cut. In the conversations where we have embraced interest rate cuts, the Russell 2000 has outperformed. And you are looking at a scenario where in the Russell you could see a scenario play out where we're talking a breakout of the Russell 2000 by the end of this week at 2100 versus a breakout of 5300 in the S&P. And I think that's a very compelling and entertaining conversation, quite frankly.
No, you can see lots of winners. If bulls can pull off, they have the technicals, they have some momentum. They can get a little bit of catalyst driven things
to continue the improving condition. Would you agree that we need to see a miss this week on inflation?
Oh, you do. You're not breaking out if you don't get a miss, and an in line doesn't break you out, doesn't tank you, doesn't break you out. You need to miss. You need to excite the bulls that those rate cuts.
Yeah, there's no
coming.
Good news is bad news, and bad news is good news this week. If inflation misses, that's good for the market because they will embrace a rate cut and an improving inflationary condition. And the central bank, even though in the last week and a half they've said all the right things, at the end of the day, when you listen to the official commentary, they want to cut.
They want to cut. They want to cut desperately.
They believe the data, whether they know it or not. Powell has hinted to the data coming down the road on inflation that would be a little bit better than the last 3 months. He has hinted to that in speeches. Does he know something? Does he not? We'll have to wait and see. But it does feel like the Fed feels like there's going to be some misses here.
Yeah, Janet Yellen knows something. I know that. I don't want to shortchange the earnings conversation. So let's go get to some of the other areas of the market. I'm interested to see your report card. One last thing I'll say on the inflationary. I have a plan basically, based on the data, like, oh, what if we get really good data? What's my plan? Oh, if I'm wrong and that data is hot, what's my plan? And if it comes in line, what's my plan? Right? I think having a plan in multiple scenarios this week is not a terrible idea. It's not a terrible idea. A terrible idea is probably not to add gold. Is it a day that ends in Y? You probably should add some if you don't own anything. Matt, this is a good look for gold as we head into the week, isn't it?
Yeah, it is a good look for gold, and gold could be a really good hedge against the potential inflationary miss this week. Because if you do see volatility to the downside on an inflationary a miss, the dollar would go up in that environment. That would hesitate on gold analysis, but gold would be a preferred instrument over the next few weeks in that scenario. So I see it as a decent hedge right now against the market volatility. But even outside of that, it's a day that ends in Y. We're going to like gold. The one thing I'll say on the technical side here on gold is real good price action in the last 2 weeks on gold. Once we gave up the 9 EMA, once you gave up the 20 SMA, when you give up your trends like that and the support catalyst within a trend such as that, you don't have to go far the S&P 500 to see what volatility looks like when you do give up patterns within a trend. Gold didn't really show any of that. And the 2 days you had big spikes.
It did not want to sell.
No, well, show me an investor wants to sell their long-term gold.
Yeah, I mean, in Mountain Dew markets, when something wants to sell and they break those trends and those technicals like you were just talking about, it sells.
Well, yeah, because you get the algorithm response in the stock market, but then you get the individuals,
and then individuals fuel it, and it gets a little volatility. None of that happened on gold
because the investors don't have the desire to sell their gold. Like there's people that own physical gold right now, they're not dumping for any reason.
Central banks aren't dumping
and adding. When you're looking at the digital side of the equation, why would you dump against some of these longer term trends? And the amazing thing is the gold investors, and we know a lot of them, they've had every reason to maybe even just say, yeah, let me lock in a little bit of profit along the way here. And you just really haven't seen additional volatility off random spikes. And again, you got 3 random spikes of volatility in the last month and a half or so. One back here in mid-April. Next day was a hammer candle on the top side that wiped it out. Then you had a sell-off fairly aggressively when you clipped the 9 EMA at the third week in April. A doji candle followed by absolutely nothing burger. And then you had a potential violation against another support level at the end of April. And the next day was an upward movement in price. So you haven't really seen any weakness outside of intraday analysis here. The daily chart hasn't really showed weakness. The weekly chart hasn't showed weakness. And so until it does, like, I don't think we're looking at a top here on gold. I'm not sure we will be looking at a top here on gold for a while, in terms of the longer term trajectories. But in the short term, this looks pretty good. Looks like a nice little breakout back up above the moving averages. Same problem in the S&P because the volatility was not significantly to the downside. Now that you have an improving condition, you do not have a long journey to resistance. It's a stone throw. It's one candle away. You're one candle away to resistance in the S&P, and you're one candle away to resistance in the in gold right now.
It's funny to think of it in those terms, but that's a good way to think of it in traders and how we could be having those all-time high battles sooner than later this week, right?
Legitimately, we could be doing it by the time somebody listens to this podcast tomorrow. We could be having this conversation at 5,300.
Yeah, no, I added after trimming a little bit, did a rules-based approach. I started adding early last week, added a smidge to the end. I will be adding some to this week, right? I think it's a great story for gold. I don't know. We went over it about 8 billion times. And check out Pete Thomas's interview with Matt to have a deeper conversation. That's on the podcast from last week. If you missed that, if you are a gold person, if you're a commodities person, must listen. Absolutely must listen. Super fun. super fun conversation they had.
Don't
You know,
sleep on silver. Don't sleep on silver. Silver's got a very similar conversation to gold, but it's a 1 day in front of it on its pattern development. You're already at the 29.
this one caught me by surprise, Matt, this week. I'm like, oh, I did. I haven't been surprised in markets very much in the last little bit. This one surprised me.
Well,
The,
how many times have we seen silver do exactly what gold did, break the support level, but silver's all the way down to 20?
yeah, exactly. Like I was just playing this by the book on silver, right?
But no, a real good improving condition. And silver's got a multiple time frame breakout at 29. It's got a short porch to 30. The ultimate conversation is 30, but I could see a breakout in silver 29, little front run going into that all-time, not the all-time, that's up closer to 50, but 29 and 30 are both very compelling, and there is not a level too concerning above 30, honestly. So I'd keep an eye. It's hard to break out of these extremely important resistance levels, but that's also why you're always here for the conversation, because if it achieves it, man, those very powerful resistance levels, they become an extremely powerful support level as well.
Yeah, no, well said. You know, one chart that hasn't been as fun has been crude oil, right? It feels like we're in for a battle because this has been a story of trends over the last little bit. Now, whether that battle occurs here or down at the 200 weekly, which is about 75-ish in that range, feels like a battle's coming up, right? If you break short-term support, you're hitting that 75 probably really, really quick.
Yeah.
And then let the battle let it get going, right? You know, it's
Well, whether it does it here or there, I really don't care personally, because I don't have any interest in oil right now. On the bull side, and on the bear side, you're too close to that vitally important 75, 76 conversation where the 200 weekly is. Crude oil gets so many conversations regarding the geopolitical situation, and that's fine. I got this extremely technically driven right now.
and that's all I'm going on right now. There's going to be a point where you want to put in fundamental analysis. Right now, that's not it. You know,
Yeah, that's in a bottoming pattern at the 200 weekly. You'll make up whatever fundamentals you need to, because that's going to be a technical saga as well. The fundamentals really hasn't changed in the upward movement in price versus the downward movement in price, and I'm not kidding. You tell me fundamentals were different over here versus the current price. That's not my read.
no, that's not
My
read
read
either.
is there hasn't been a real change from there to there, quite frankly, and these trends are just trends. It's a technical story, quite frankly. But when you are looking at that technical story, just when you're looking at a conversation called potential average yield, it's the vertical distance that an area of the market can run from support to resistance in a bullish uptrend, or resistance to support in a bearish downtrend. And right now, crude's running at about $6. That's what it's running. It ran from right around 87.5 to 81.5. Then it ran from 84 from resistance down to 78. Resistance at 80. If you talk about that in a slowing momentum environment, which typically you do get in a fifth leg in a trend, that would put you at around 75 to 76, which is right where the 200 weekly is. And so we can talk about all day long the fundamental condition. We can talk all day long about the behavioral condition. We can talk all day long about geopolitical situations. But the reality is, this is a technical story being played out. And so let the technicals kind of do the talking here. Right now, I would expect a 200 weekly test here, and I do think that would be a gift to the trading gods, because I think we'll get into short-term reversals.
You know, oil speculators on war have been punished in oil over the last year. Geopolitical headlines have not favored. They've created volatility. They've created an environment where volatility can occur on both sides, right? And so, So I think the next time you have geopolitical there's going to be a lot less hesitancy to push oil as whatever, right? I think it's been hurt far more than it's been assisted by those headlines.
Because ultimately, for the headlines to impact oil, you're actually going to have to see a war between the U.S. and Iran. and that just hasn't played out. Even when they were literally doing historical things that didn't play out. And that's why I see this technically. I do not see this geopolitically based. It's very technically driven right now. The candles are very consistent against the technical backdrop. I just think we wait on a 200 weekly reversal, which we have done before, and it has proven very, very successful. So let's let that play out a little bit.
Waiting for reversals on crude oil in particular, they usually take a while. They reward the patient, and they put a few bucks in your bank when they play out. I don't, Bitcoin. A lot of things could happen. Not a lot to the chart today. You got to bearish or bullish lean in the short term on technicals, Matt. Or are you just like me?
I think it's tough, honestly. I am in general. I don't have a strong opinion, and I don't think it pays to have an opinion on the bull side here. So I would say in general, the longer term reduction in resistance is a little bit more powerful to me than the potential fake out analysis on the breakdown. So I would say the lean would be to the bear side as of right now. But 60K is an extremely powerful level as well. And so you got on the bull side of the equation, you got 60K, which is a significant hold number that's been proven out, and it's in the lexicon of support analysis now in the Bitcoin community. You got the failed breakdown of 60K, so that's on the bull side. On the bear side, you got 2 consecutive lower levels of resistance. And so I would have to put the lower levels of resistance as a little bit stronger in the short-term analysis than the potential fake down or the strength of 60K. You also, I think, got most of the moving averages working against you right now, not for you. And that's never going to be a positive sign. So I would have to say the edge is to the downside here, but it's a triangle more than anything, and symmetrical.
Yeah, I mean, the rising 9 monthly, which is a big favorite of mine to take stabs from a position long-term invest, it's clear down to 50,000. Like it's still 20% below.
Well, and I'll have a much stronger opinion on the bull side of 50 to 55K than I would at 60K. Because again, when you get into reversal analysis, it is so stinking hard to say something's reversing when it hasn't been bearish downtrending. Like that's an impossible thing to do, to say, oh, it's reversing when you haven't actually had a short-term downtrend yet. And you haven't had a short-term downtrend yet, because you have not seen a sustainable trend underneath 60K. That's where the bull side comes in, where you got that fake down. You had the potential of that bear trend for the Bitcoin bulls. Like, yeah, they're like, here, for somebody who wants to add, I wanted to see lower price here, no, quite frankly. But you had the potential of a downtrend here, but that fake out puts it on the bull side. So no, it's mixed time frames. It's mixed everywhere.
It's messy.
It's
just messy.
It's time.
Listen, I did not pick, pre-production, I did not ask Matt his final report card for earnings season, because I wanted to be a fly on the wall, or actually not a fly on the wall, because I'm here talking to y'all while I'm doing this. But I wanted to be like, oh, where are we? Because, Matt, I make decisions. On the edges, just based on your final report card for earnings, because I cannot trust the financial media headlines, because they will call an earnings season the greatest earnings season in the history of mankind, even when it's not. On the flip side, sometimes they'll be like, oh, that was when it was much better than. I trust you. Give me some numbers.
Well, my opinion is not a strong one this earnings
That's
season.
fine.
And
that just so all right. That's a podcast. Thanks for listening to 578.
I do think it's important to understand the backdrop of earnings. If I were to letter grade it, and I should put a letter grade in the earnings report card that I do in the newsletter.
Dude, I like letter grades. Dude, I think people like letter grades.
Yeah, I'm gonna start doing that. I do during earnings season in the newsletter. I always do an earnings update where I went through this week some fun facts, talked about the performance a little bit. I always do a little bull quick hits, the 4 best reports of the week, bear quick hits, the bearish ones, and I do a combination technical fundamental analysis when I'm picking the best and the worst of earnings season this week. From a macro perspective, I think you gotta the first couple weeks versus the next 3 weeks of earnings season has been, the first 2 weeks of earnings season was really, really bad in my estimation. Banks got sold, cyclicals got sold, and really what you had was a massive healthcare problem with Bristol Myers just being the absolutely dog of the dog out there, with a massive lowering of guidance. Gilead Science was also a problem child within the healthcare space as well. But from a macro perspective, I would say after the first week and a half, 2 weeks of earnings season, it's been an improving condition, and the technicals have kind of matched that improving condition from an earnings perspective. When you're looking at the macro numbers of EPS beat, revenue beat, as well as the all-important blended growth, EPS beat like straight up average. The 5-year average is 77. The last 3 weeks has been 77, 77, and 78. We really haven't budged there from the mid to upper 70s on EPS beat over the course of the last few weeks. In the last week, the EPS beat percentage did contract a little bit from about 8% beat to right around 7.5% beat. But the 5-year average is like 8.6% EPS beat rate versus the 10-year average in the mid sixes. So honestly, a 7.5 EPS beat percentage is about average, I would say, between the 5 and the 10-year average. So EPS was an extremely average quarter. I'd give it about I'd say B- on EPS beat, just straight up average. On the revenue side of the equation, I felt we've had a revenue problem this quarter. I'd give it a C. From a revenue beat perspective, the veracity of the beat was less than the 5 and the 10-year average. You've also the 5-year average on revenue beat 69%, 10 years slightly less than that, but we're coming in at 59% right now in beat, and we didn't really sniff a good revenue storyline all quarter long.
That's pretty significantly lower. I mean, that's notable. I mean, it stands out.
Always lower than where they really do their great work on manipulation of data is on the EPS side. On the revenue side of the equation, like it's always less than the EPS side. And the manipulation of data is the lowering of earnings expectations. They do that on the EPS side, not on the revenue side. So I apologize for the comment there. I didn't mean it that way. When you're looking at the revenue beat, yeah, I do think you're a little bit concerned on the revenue side. You're coming in at 59% right now. But again, my opinion isn't necessarily just based on the 59% beat rate. It's also based on me analyzing 500 different earnings reports in the last 5 weeks. It's also based on the veracity of those beats as well. I will say this on the EPS and the revenue side of it. EPS, this is the 3rd consecutive quarter mark, and that's officially a streak according to Major League. But the 3rd quarter in a row where we've had a positive quarter from an EPS perspective. We were going through a little bit of an earnings recession in 2022, and the last quarter, or 2022 going in 2023, excuse me. The last 3 quarters have been really, really good. We got above the 0 level 2 quarters ago. That got confirmed last quarter, and now we're going to finish earnings season above 5.5 growth out there. And so, in general, EPS is a positive story. In general, revenue is a slight negative story. Now, the blended growth number, it was fascinating to track this quarter as it started out at 3.4%. Now, in the first 2 weeks of earnings season, you went to 0.9%, then to 0.5%. That was based on 2 things. The banks came out and they were fine. It was not banks. But you did have a slight contraction due to the banks. But what really happened was the downgrades in Gilead Science and specifically Bristol Myers out there, who had some fairly sizable charge-offs. And so blended growth got absolutely smoked. In fact, Mark, right now the blended growth has improved to 5.4%. If you discount, and the average improvement is right around 8%. Okay, so we start the quarter out at 3.4%. Really, a 0.9% is kind of the start, though. If you discount Bristol Myers, Mark, the blended growth rate on EPS is 8.5%. If you discount just one company, and a company that is not usually important to this overall macro storyline in the marketplace, we're talking about blended growth at 8.5%, which would be a really good earnings season to go from the first week when you start at 0.9 to getting into 8.5. That would be a pretty good earnings season, quite frankly. Now, you can't discount it. You have to take into account, but that's just a little bit of
But
context.
you can kind of discount it, like in the sense that, like,
it's better than what the actual numbers look like because
yeah, I think that I'm glad you point that out, because it does, like, oh, okay, so pretty decent earnings season on that front,
Yeah, it was a very decent earnings season on the blended growth, and especially think about this from a general's perspective, Mark, because the generals don't report in week 1 and week 2. That's healthcare stocks, that's secondary stocks, that's financial stocks, that's regional banks, that's insurance companies, that's the Wall Street banks. They're all reporting there. It's week 3 that you start getting into Tesla week, and even that was week 2 here. So we had a condensed earnings season. Week 3 was when you got into Google and Meta week, and you saw a sizable bump up. The general stepped up in earnings season. They carried, and even though everybody and their dog was saying Meta sucked, Mark, what did I say about Meta's report of the day of Meta?
Yeah, that's why I listened to you and not
and it was because people want to give context to stock going down on earnings, and they're like, let me find the reason.
Things have to make sense that day, right?
Yeah, there's a lot of things that can happen on earnings day, though. Week 4 was Amazon, Apple week. You saw improving conditions there, and then we improved into 5.4% by the end of last week. So I do think the blended growth was definitely a positive for the marketplace. EPS slight positive, blended growth certainly a positive. But again, blended growth is, the way I report it, is blended EPS growth. So those are kind of one and the same. When you're looking at the revenue, a little bit of a contraction, bad start, better finish. I got to give it a B minus. I can't get above average here. There's too many.
B minus, is that what I heard?
B minus, and that's an improving condition. I was on a C plus going into the week. Now I'm at a B minus, and that will be my final letter grade for this earnings season. It's not one we will remember in a quarter from now.
It sounds like this earnings season, like it's doesn't change the story one way or another.
It was good enough to get the market to stabilize, but it was not good enough to get the market to break and run on a growth argument. That's going to
nor bad enough to get the market freaked out about anything.
Now, with that said, we still have some to go. Now on the growth
side, but Walmart's
that's not this week. That's not this week.
Walmart. I mean, because Walmart can create that consumer catalyst, right? So you Home Depot on Tuesday, right? Looks like a couple Chinese stocks.
3 reports this week, I would say, is Home Depot, Walmart, and Applied Materials. Don't sleep on Applied Materials. They don't get the headline.
Oh, I missed them looking. They got to darken their logo there. I could barely see it.
Close on Thursday.
That's a huge. No, that's an absolutely.
Applied Materials is a big name.
So you got consumer and AI this week, and that's worth paying attention to.
Especially on Thursday. Thursday's a big day. You got Baidu, you got JD.com on Thursday. But I would put head and shoulders Home Depot, Walmart, and Applied Materials. Now, the generals, Mark, remember, somebody's got to lead the charge. The market's not going to break and run with utilities being the number 1 sector in the marketplace. It's not going to happen. We're not going to see a leg up in the market with utilities leading the charge. But the generals did step up. If you look at the blended growth right now at 5.4%, if you discount these 5 companies, NVIDIA, Microsoft, Meta, Amazon, Google, blended growth at over a negative 2%. Okay. With them, we're at 5.4%. Without them, we're at a negative 2.4%. And so the biggest impacts to the blended growth came from the generals. They stepped up. Now, where they knock your socks off? No, we'll still have to wait on NVIDIA's. NVIDIA's blended growth is based on projections. Remember, blended growth takes into account the companies that have reported in earnings season, and it takes into account the projections of the companies that have yet to report in earnings season. NVIDIA is the only general that has yet to report earnings. Now, Mark, just off the beaten path. Now, I do this in the Tackle newsletter every single week. Not going to do it obviously in the podcast every week, but I just want you guys to be familiar with one of the things I do in the newsletter, so that if you're not embracing that newsletter, you start doing it. Every week, I do 4 quick hits on the bull side of the equation. This week, Toast, Shark Ninja. Shark Ninja was a great report, number one. They have a great trend. They have a great report. They pulled off the hat trick. Shark Ninja, one of the better reports this week. They don't get a lot of love.
One of the best names in the market, too.
Put it on your watch list just for the name. Keep it on your watch list for the fundamentals here, because really good report out of Shark Ninja. Toast makes the quick hit bull side of the equation this week, because average report. I don't want to come across as, oh, knock your socks off report out of Toast, but they have a knock your socks off technical condition following that report. That's why they made the list. AppLovin, Coach Frank's one of his favorites, both on the bull side, on the bear side. He's running that bull freight train right now. They had a really, really good response, pulled off the hat trick. For the 3rd week in a row, a gold stock does make the list, KGC. They had a really good report, not your new mining report, but they had a really, really good report. Royal Gold had a pretty decent report as well. Last week, Pfizer, Garmin, CBNA, Howmet all had really, really, really good reports. The week before that, Newmont, GE, Hess, GM, the 2 generals there, they had really, really good reports too. And so I will say there was some true standouts from an earnings perspective. Those 12 stocks I just talked about were definitely earnings standouts this quarter. And again, check out the newsletter for, deeper analysis than what I give here. On the bear side of it, Mark, I didn't pull up any charts here or anything, but on the bear side of the equation, I would say Uber, just a terrible EPS miss on Uber. Tesla, I thought Tesla's report was garbage, quite frankly. They got a lot of Elon love. What will you do in the future type conversation? But as for the here and now, they're not producing anything from a numbers perspective to get too excited about. Intel had a bad miss and a drop in forward-looking guidance. AMD, I would put on the list just solely because they bored me, and they needed to not bore me coming off that.
You can't bore people at that valuation. You just can't.
Just get them excited. Starbucks, I thought, had the worst report of the entire quarter. There was a couple really, really bad reports, but I don't think there was a report that just missed the mark more than Starbucks. They don't get it right now. They do not understand the inflationary conversation right now. They don't understand their consumer right now, and they need to make substantial changes. I watched the CEO on CNBC the following day. I thought he just was terrible on the messaging side of the equation. And if you're terrible on the messaging side, the only reason it's on there was for the messaging, and it was terrible. And I thought the messaging was
if you don't get that consumers are strapped, then your stock is going to suffer. You know what McDonald's is doing, Matt? We've criticized McDonald's several times. They're bringing back $5 deals. They're talking about bigger portion size. They're doing things because they recognize that if they don't, they're going to suffer, because they have to understand the environment.
The consumers is not going to spend $8 on a caramel mochaccino. Not going to do it. They're not going to do it. They're going to start going to brew their own Folgers. That's where did you know, Mark, that consumers have got tapped out by $2.1 trillion in excess savings in the last 2 years? Did you know?
I did, actually. I was compiling my own notes.
$1 trillion. 2 years ago, consumers in America had an excess of $2.1 trillion. $2.1 trillion in excess.
And there's that South Park skit where they were making fun of the financial crisis, and it's gone.
And it's gone. But it's not gone because price went down. It's gone because inflations went up. not price going down in the market.
Because we know the American consumer will spend. We know this. There's forever,
They have money
right?
they spend. If they have money, they spend.
But they have reached a
guess
wall.
what? They will stop spending on discretionary items that they do not understand why they cost that much. And Starbucks has a pricing problem. And I don't like, I wouldn't even say McDonald's has a pricing problem. They have a quality problem. Although I do like the $5. Listen, McDonald's changed course where they re-embrace the $1, not the $1, but the breakfast menu on for 24 hours. We'll see if McDonald's can turn this around with that. But Starbucks, nah, I'd say Starbucks. Just the combination of the absolutely horrific earnings report, the lack of awareness on what people are dealing with in America today from an inflationary perspective. I just felt Starbucks was a standout on the terrible side of the equation. So we certainly had our hits and we certainly had our misses, but at the end of the day, I think the number one thing that probably kept the market afloat was the blended growth number. It produced throughout the last 3 weeks. Without that, you're talking about probably the S&P at 4,800. So you got to give a nod to that. And I do think the better beats were better than the worst misses. So a B- makes some sense for me.
Yeah, well, thank you for. I mean, seriously, thanks for the hard work you do on that. I do appreciate it. Well, that's going to wrap us up on our show. But Matt, I do want to highlight. Listen, go to the description. Matt is he is a burgeoning expert on AI. He just is. Like from a market perspective, from an understanding, valuation, how this is going to impact companies, where to look. That's important information to put in your noggin. And Matt will be speaking on it this week. Go to the description, sign up, even if you can't attend, but if you can, certainly be there, support Matt on that. But Matt, give us some final words as we head into, out of earnings into inflationary week.
Well, I wouldn't call myself an AI expert, but I do.
I said a burgeoning expert.
I do research and study it quite a bit.
Burgeoning is a good word.
Listen, the architects of AI are the experts. Sam Altman, he's an expert. Me, I'm just a fly on the wall.
Sam Altman ain't telling me where to invest some money. And look, you don't understand that part of the market, which is the one part I
probably do understand that side of the equation a little bit better than most people.
Don't sell yourself short, bro. I'm always telling Matt he needs to promote himself more. He's terrible. He's actually freaking way too humble about this crap. So I will deal with it.
Like this conversation anymore.
I know you're coming, and which means this podcast might go on for another hour for my own enjoyment.
I guarantee you that I will teach even people familiar with AI something new on Thursday. Yes.
Well, very, very, very cool. Any other thoughts as we close up shop?
No, definitely just come hang out with us on Thursday during the New Tools of Money event. You can sign up for free. It's a free event. There's going to be wonderful speeches there, wonderful awareness, teaching all of our communities these amazing concepts. So definitely come join us. We're going to have a lot of fun there. And if you have any questions for us, you can always hit us up at team@Tackle Trading, our wonderful sponsor of the Trading Justice podcast. You can always hit us up in the Tackle Trading Discord. And at the end of the day, if you are looking for an amazing community of like-minded individuals that will help you navigate the financial world on a day in, day out, week in, week out basis, and help you on the application side, teach you everything you need to know about the markets, there is not a better community that embraces the dual-pronged approach of education plus application in the financial world than Tackle Trading does. So go over there to www.tackletrading.com. I had to put that www in there, Chucky, and sign up for a free trial. You won't regret it. You'll have a lot of fun.
Listen, everyone, have a fantastic week.